think that the big misperception is this view that there is a lot of stimulus in this budget bill, and there really isn't. When people talk about that we're going to be tacking on $3 trillion additionally to the debt over the course of the next decade because of this budget bill, all of that and then some, like $4 trillion of that $3 trillion is just from extending the 2017 tax relief package. So just to maintain the status quo and not fall off the fiscal cliff at the end of the year means that you're going to be tacking on $4 trillion. What is being missed in the market, what's being missed in the media, is that when you tack on the actual net new tax provisions and the net new spending restraint, and then of course a lot of that future deficit increase is because of the fact that the Fed is keeping interest rates pinned at a more elevated level, so you have $500 billion plus of incremental debt service costs. Well, that doesn't go into helping out the economy. That's interest charges on the debt. Actually, when you take out your pen and paper, you do the arithmetic, this big, beautiful budget bill will actually drain real GDP by 0.5% per year on a $30 trillion beast, otherwise known as US GDP. That is not chump change. So what's being missed is that when people talk about, well, look at all the stimulus, they're including in the stimulus the extension of the 2017 tax cuts, which were supposed to expire at the end of this year. That's not real stimulus. That's basically, when you look at it benchmarked against the status quo, there is no stimulus in this budget. There's actually fiscal drain. And if they allowed the tax cuts of 2017 to expire, and maybe they should. I mean, there was a sunset clause put in there for a reason. Of course, a lot of that was to get the CBO budget scoring so that it could get passed. But it's just the same thing with government. Things have a sunset clause, and the next thing you know, they're made permanent. So that's my message really, is that if they let the tax cuts expire, mostly on the personal side, you'd have had an annualized drain on GDP of, say, closer to 2% than 0.5%. But either way, no matter how you slice or dice it, this is a fiscal package that should lead you to be reducing your long-term economic growth projections. It's stimulus only if you are taking the number off what was to expire. But really what you have to do is look at the budget bill benchmarked against the actual status quo, the actual here and now. So yeah, to me, it's more that you avert falling off the fiscal cliff more than adding stimulus to the economy. People have underestimated how deep the spending restraint is in this budget. And of course, you can't really count in incremental debt service charges. Of course, that adds to the debt, adds to the deficit, but doesn't add to the marginal utility of economic growth. So you have to take a look at program spending, the net tax reduction, net, and it comes out towards taking real GDP growth, whatever baseline you have. And of course, we don't know what's going to happen in the Senate, but what I'm hearing from the Senate is that there is going to be more cuts on the spending side. So when I say that this is a net drain of 0.5% per year for the next decade, I'm amazed that nobody else has anything talks about that number. Everybody thinks this is stimulative. The stock market certainly thinks it's stimulative. It's not. I think that there's a real misleading narrative out there right now. A good chunk of the economic expansion that we've had, which people called American exceptionalism. And of course, I think that the inflection point in the technology curve that you could say started in the fall of 2022 with ChatGPT and NVIDIA and so on and so forth. But then we're seeing China has played some serious catch up on that score. But the American exceptionalism was really, the Biden chip subsidies, the oxymoronic Inflation Reduction Act that had so many tax expenditures and other subsidies and spending. Most of the growth that we had in this economy in the past 5 years came from the government sector, not to mention $2 trillion of stimulus checks that kept the Energizer Bunny going right up until last year. When I'm taking a look at the economy, we're going to be seeing some significant fiscal policy withdrawal. I think that's radically underestimated. And then for better or for worse, I'm not going to sit here and debate whether we should get rid of abuse, waste, and fraud in the government spending. I mean, who doesn't want that? And who doesn't want better border controls and maybe a more sane immigration policy? However, there's economic effects. So even when you look at, for example, tighter immigration rules, well, there you have up to another 0.4% per year of drag on GDP. Whether they're native born or whether they're immigrants, people make up GDP. Well, that's going to be 0.4. And if you remember, one of the reasons why the Fed had been raising its estimate for R-star, or the natural rate of interest, was because of the very dynamic demographic developments taking place over the past few years. For better or for worse, I'm not going to get into social policy out of this or play politics on immigration, except to say that that movie, like fiscal policy, is now winding in the opposite direction. You had a whole bunch of other goodies out there. What about student debt relief? Well, that just officially ended. You could argue not a big deal, but that's, call it 0.1%. All of a sudden, the freebie is over for the student sector. They tend to spend most, if not all, of their income. So you add all this up, student debt moratorium over. Immigration rules being tightened, the shift from fiscal stimulus to what is net fiscal drag. Well, just from those alone, you just lopped off a percentage point off your baseline GDP growth. Well, where's baseline GDP growth right now? I speak to most people, they still think it's 3 or 4%. I cannot begin to tell you how many people still have their heads either in the sand or wrapped into the memory of the past few years. No, the run rate on real GDP growth right now is down to 2. And now we just had policy shifts, but just in terms of student debt, immigration, fiscal, right there, you've lopped 100 basis points off your baseline GDP growth. So you've gone from going from 2 to 1, just from that alone. And if you're going to take aggregate demand down by that much, you are going to have an increase in the unemployment rate. You're going to have more economic slack. And all the concerns about inflation are going to prove to be misplaced. So that's where I'm coming at it. Even though we haven't even mentioned tariff, trade, reprieve, deal, telephone calls, on and off policy. We haven't talked about the effects of that yet. Everything else that I've just discussing have been headwinds. The only tailwind that I could think of are data centers, okay? That the AI revolution is real, and that's providing an offset to be sure. But you know what? The advent and proliferation of the internet, back in the late 1990s, that was a massive productivity shift in the economy. And even as society benefited from it ongoingly, and that never stopped, we did have a horrible recession in 2001, and then hardly any recovery for the next 2 years. And it was Iraq War II that helped us get out of the torpor at that particular point in time. And then you got to count on the fact that the rest of the world is pretty well flat in its back. I guess that we could say, well, but look at Germany, they're loosening the fiscal rules and it's going to have a big impact on Europe. Yeah, but they're going to be spending money on defense, and it's going to be for their defense contractors. Europeans are going to benefit from that. That's going to be homegrown growth that will certainly benefit Europe, but I don't think there'll be much spin-off into the United States. But outside of that, the rest of the world, and especially with the tariff and trade shock, the rest of the world is going to be fundamentally weak. So you're not going to get a big shift into the export sector in the United States from this. And the export sector might not be a big share of the economy, but it has huge indirect impacts on the economy. And then we get into what else is happening. It's very interesting to me that apparently we're going to have 30% tariff here, 145% tariff there. Then we get a phone call, whether it's China, the EU, your head just spinning on all these changes that are taking place. But what's interesting to me, and this comes down again to the economic outlook for the United States, is that people around the world are taking matters in their own hand. So you might have the president of the EU, cap in hand, going to the White House. You could even argue that it was Xi Jinping that made the call. You certainly know that Keir Starmer over in the UK is doing everything he can to cozy up to the president. Japan, the same sort of thing. But the populations of these countries, and I live in Canada, and I can tell you that you can't go into a store and not see the Buy Canada signs everywhere. And people are deliberately not buying American products. This is happening here and it's happening abroad. So even as these governments kowtow to the administration, the residents of these countries that make up GDP, politicians signing agreements or deals or whatever, they don't make up GDP. The people do. And so you're seeing this, and it's been reflected in the US dollar. People are boycotting as best they can U.S. products. You are seeing U.S. exports sitting on the shelves at the department stores and at the grocery chains. So those strawberries from California, when you go shop at Pusateri's on Avenue Road, they're going rotten. And all this could have been avoided, and it's actually quite sad. But the biggest impact is on travel and tourism. And Oxford Economics just put out a study saying that foreign travel and tourism into the United States is going to be going down 9% this year. And when you're taking a look at the economic reopening post-COVID and what drove the economy, what drove the labor market before ChatGPT was travel and tourism. It was the hospitality industry. It was going gangbusters, and that is a very labor-intensive industry. It's a huge employer. You're talking about hospitality industry and all its spin-offs supports 20 million jobs in the United States and touches $2 trillion of GDP. And people are deciding, and certainly you got to be seeing that too. You are seeing what WestJet, Air Canada, other airlines, they're canceling flights and reducing their frequency of trips into the US. And it's not just from Canada, but it's from Europe. So, when you start tacking that on, we'll see it because we're heading into the summer season. We're heading into the part of the year where travel and tourism is expected to really boom seasonally in the United States. I think that is going to be a big disappointment because travelers are either choosing other destinations or they're just staying at home. I mean, the question for China, and that's the elephant in the room, is does China have the capacity and the willingness to shift its economic model towards consumerism and away from its export dependency? Now, it's less export dependent than it has been in the past. 20% of its GDP are exports. That's down by about half from where it was a couple of decades ago. And its reliance on the US has actually gone down. The US will not bring China down to its knees. So for China, the choice is to shift towards a more consumer model, get those exorbitant savings rates down. You don't have to go into massive consumerism with gobs of debt like the United States has, but certainly make it a more consumer-oriented economy. Can that be done? But the one thing that you cannot underestimate China is its ability to cobble together relationships in other parts of the world. The massive investments it's made in Africa over the years. It's increasing ties in South America, Europe, and of course the rest of Asia. And I don't think that the United States, I don't think Donald Trump will be able to break those links. And in fact, the risk for America is that those links with China and the rest of the world are going to increase, not decrease. I think it's folly to believe that we're going to come out of this with China's share of global exports going down. It's probably going to go up. And the US will become increasingly isolated. Like we say all this is still early days yet. I mean, Reciprocal Liberation Day, that was April 2nd. Where are the early innings here? And we don't know. We just know how the markets are like Pavlov's dog. They'll risk on assets, sell off dramatically on a tariff increase, and then a day later or over the weekend, there's a telephone call and a deal, and the markets rally. It's like a massive roller coaster ride. But we are going to come out of this with higher baseline tariffs, at least 10%, and probably more than that for China. That isn't the worst case scenario. The worst case scenario is what we saw April 2nd. But this hasn't fully played out yet. I think that when you're taking a look at the markets, you're going to say to me, how are the markets responding the way they're responding? How is this possible? Because the markets are making an assumption. Then it's up to me and you to say to our clients, well, do we agree or not agree with the assumption? The assumption is that Trump is changing his mind so much. Investors now believe that he's not going to carry through with the tariffs. He's going to continue to kick the can down the road as long as he can. That's the prevailing view. But then you have to ask yourself the question, at what point do you start to lose your credibility? Like the question is, say from a geopolitical standpoint, is Vladimir Putin, is he watching this pattern of behavior on the trade side? That Trump is willing to say one thing and threaten and then pull back. So if you're an aggressor, and Putin's obviously an aggressor, so look how this plays out in the global field. At what point you can only play this game of threat, reprieve, got a deal on the phone. You can only play this game for so long. It does have an expiry date. And then your credibility starts to erode. And then that leads to a whole bunch of other problems when you have a president who loses credibility as to what actually ends up getting done on the legislative side.